One reason that you could argue for the Fed staying the course, but again, even here, there are many shades of gray. And as you point out, the ISM services report, what does that tell you about the strength or lack thereof we may see in the future employment reports here?
Well, thanks, Kelly. Happy to be on with you and Steve. Well, the ISM service report was quite surprising and ugly, really. We saw new orders, demand plummet. You saw the overall headline index notably fall more than 6 points below 50, and that's the dividing line between contraction and expansion. So it suggests that non-manufacturing or service side of the economy is actually contracting. That's pretty surprising. We knew manufacturing was, right?
Yeah.
ISM manufacturing was down 2 months in a row, but this is the broadest part of the economy, right? And it doesn't turn very often. And when it does go below 50, it's typically in line with recession. So makes me think about those employment numbers that came out, an hour and a half before that maybe that was just like the last strong kind of stand on payrolls, and it was consistent with GDP growth that's near 4% in fourth quarter. But that's old news. And going forward, companies are really starting to get cautious and pull in the reins on spending, and hiring can't be too far behind.
Sure. And Steve, the mismatch that I sense that people would like to hear more from the Fed about leading indicators. The market goes, we're all forward looking. We all know that this data. So if you look at when they started stimulating aggressively, they in fiscal, March 2020, let's call it, we didn't hit peak nominal GDP growth until the last quarter of 2021. That was a year and a half later when we hit almost 14.3, almost 15% of nominal GDP growth in that quarter. So whatever they're doing now is the market's trying to figure out what that's going to mean 18 months from now. They don't care what December's wage report was unless, like Kathy says, it already suggests a deceleration.
I don't know what Kathy thinks, but people want to hear that the Fed is in the same universe that they're in. When they see inflation coming down, when you see the 5-month annualized inflation report, you see the ISM services sector, okay, maybe you are still a believer in heading to 5%. But where's the discussion about the economic risks? And most importantly, where's the discussion about the impact of the balance sheet? We had a $400 billion runoff last year or so, and it's going to be $1.1 trillion. How is that modeled in? Is that $1.1 trillion? Is that 200 basis points? Is that 100 basis points? How much is that? And does that give the Fed any pause? Here's the thing, Kelly. It just strikes me that if we can avoid a recession, we ought to try to do so.
Absolutely. By the way, we were just talking about leading indicators. We have a quick market flash on yields with Rick Santelli in Chicago. Rick, what do you see?
Well, the 3 months to 10-year, once again, without belaboring the point, almost on a daily basis. And even since the Fed minutes, which were assumed hawkish, we continue to see more inversion. 3s to 10s now is basically in the neighborhood of minus 110 basis points. This is the most inverted since the inception of this, when we started moving from prices to yields in 1982 for the 3-month bill. And it doesn't just end there. 3 weeks is the last time we've seen 10-year note yields at this level, and Fed funds for June of this year, and I like to concentrate on that fulcrum, that pivotal area, continues to be bouncing above levels that were trading after the hawkish minutes. The Fed isn't data dependent. The Fed's date dependent. They pick out the date, they decide what they want to do, and the only reason I can see that the investor class and some of the journalists are starting to get so much more vocal about how the Fed is most likely well over its skis is because it's so painfully obvious that inflation has slowed.
Kathy, you want to respond to that?
Yeah, well, I think there is some truth that there's been a lack of debate and disagreement on the FOMC, and I think that's always worrisome, right? And we saw that during the transitory period, too. I think what the Fed Reserve is worried about is that the service side of inflation may not slow as quickly. There are certainly indications things are slowing, but how quickly are they slowing? But certainly, if we get wage growth continuing to decelerate and employment really starts to slow materially, then I think the Fed has to reassess. Maybe right now they're talking tough, but they have to be agile to be able to change their policy if they need to. It can be very difficult to avoid a recession, if they go too restrictive and stay there for too long.